Picture two investors, one confidently making a decision, the other overwhelmed by uncertainty. Which one are you? We all want to be that confident investor, right? The secret to their confidence lies in the science of capital budgeting, a crucial process businesses use to determine which long-term investments to pursue. It's like planning a road trip, but instead of mapping out rest stops, you're mapping out your company's financial future. But here's the thing, even the best laid plans can go awry. Unexpected events, market changes, and the most dreaded of them all, risk. That's why savvy investors employ risk analysis, a tool that helps identify and assess potential threats and opportunities. It's like having a GPS for your investment journey, guiding you through the fog of uncertainty. That's what we're diving into today. Risk analysis in capital budgeting. So grab your financial compass, buckle up, and let's navigate this together. In the world of capital budgeting, nothing is certain. We're like explorers charting new territories armed with our calculators and spreadsheets instead of compasses and maps. Every decision we make is like setting foot on unexplored land, filled with both potential rewards and hidden dangers. Now imagine you're about to embark on such a journey. You wouldn't just pack your bags and leave, would you? No, you'd first study the landscape, check the weather, and prepare for potential challenges. That's exactly what we do when we analyze risk in capital budgeting. We know that the future is as predictable as a toddler in a candy store. The cash flows we anticipate are not guarantees, they're estimations. They're best guesses based on the information we have at hand. But what if that information changes? What if the market shifts, technology advances, or an unforeseen event impacts our project? Well, that's where risk analysis comes in. Risk analysis is like our financial crystal ball. It doesn't predict the future, but it helps us prepare for it. It allows us to identify potential threats and opportunities, assess their impact, and make informed decisions. It's our way of peering into the future, and while it might not present a clear picture, it does give us a sense of what lies ahead. Think of it as a financial weather forecast. It won't tell you whether to take an umbrella or not, but it will tell you if there's a chance of rain. And, armed with that information, you can decide whether it's worth the risk of getting wet, or if you should play it safe and stay dry. So, why do we analyze risk? Because in the world of capital budgeting, knowledge is power. It's the difference between guessing and making an informed decision. It's the difference between stumbling in the dark and navigating with a flashlight. So, risk analysis is our flashlight in the dark, illuminating potential pitfalls and opportunities. It doesn't eliminate the uncertainty, but it does help us navigate through it. And in the unpredictable world of capital budgeting, that's a tool worth having in our toolkit. If you're finding this video helpful, don't forget to hit the like button and subscribe to our channel for more insightful content. Numbers don't tell the whole story. They're important, sure, but when it comes to risk analysis and capital budgeting, you can't ignore qualitative factors. We're talking about the aspects that aren't so easily quantified, yet hold significant sway over the success of your projects. Let's kick off with operational risks. These are the hiccups that come with carrying out a project. Maybe you face unforeseen maintenance needs that put a wrench in your well-oiled machine, or perhaps project delays come knocking on your door, throwing your timelines out of whack. It's like planning a road trip only to discover halfway through that you've got a flat tire. Annoying, right? But if you're prepared for these possibilities, they become less of a nuisance and more of a speed bump on your journey to success. Next up, we have market risks. These are the unpredictable changes in market conditions that can impact your project. Think about fluctuations in demand, intense competition, or regulatory changes. It's like being the hottest new restaurant in town, but suddenly everyone's on a diet. Or maybe a new eatery opens up right next door. And let's not forget the government introducing new health regulations. All these factors can significantly impact your bottom line. Last but certainly not least, we have technological risks. Technology is a double-edged sword. On one side, it can streamline operations and boost productivity. On the other, it can become outdated quickly or be disrupted by new advancements. Imagine investing in a state-of-the-art video rental store, only for streaming services to take over the market. Ouch! So while crunching numbers is crucial, don't forget to consider these qualitative factors. They add color to the black and white world of quantitative analysis and provide a more holistic view of potential risks. After all, a business isn't just about profit and loss statements or balance sheets, it's about people, processes, and the environment in which it operates. Remember, a business is more than just numbers, it's a living, breathing entity operating in a dynamic world. Enough theory, let's get our hands dirty. Now that we've understood why we analyze risk and the qualitative factors that come into play, let's dive into the toolbox of risk analysis. These tools are going to be your best friends when navigating the unpredictable waters of capital budgeting. First up, we have scenario analysis. Think of this as your crystal ball. It allows you to explore different potential outcomes, the best case, the worst case, and the most likely scenario. By analyzing these varied possibilities, you can prepare for different eventualities, ensuring you're not left high and dry when the tide turns. Next in line is sensitivity analysis. This tool helps you understand how changes in key variables like interest rates or sales volume can affect the profitability of your project. It's like your financial weather vane, showing you how your project might fare under different economic climates. Last, but certainly not least, we have the Monte Carlo simulation. Now this isn't a trip to a fancy casino, but it might feel like it. This advanced technique uses statistical methods to model a range of possible outcomes. It's like playing out all your what-if scenarios in a high-stakes game of financial roulette. Each of these tools comes with their strengths and limitations, but together they provide a robust framework for quantifying and understanding risk. Remember, these aren't fortune-telling devices. They won't tell you exactly what will happen in the future, but they can give you a sense of the range and likelihood of potential outcomes, arming you with the information you need to make informed decisions. So, whether you're choosing between multiple projects, or trying to decide if a project is worth the risk at all, these tools can help guide your decision-making process. They can help you understand not just the potential rewards but also the risks you're taking on. With these tools in your arsenal, you're well equipped to tackle uncertainty head-on. And that, my friends, is how you become a master of the financial seas. Identifying risks is good, but what you do about them is even better. Now that you're equipped with your toolkit of risk analysis methods, let's talk about how to navigate those stormy seas. It's all about risk management strategies that can help you sail smoother. First up, we have contingency plans. Think of these as your lifeboats. They're your backup options for when unexpected events try to capsize your investment. Having a well-thought-out contingency plan means you're ready to act swiftly and decisively when things don't go according to plan. It's like having a spare tire in the trunk of your car. You might not need it, but if you get a flat, you'll be glad it's there. Next, let's chat about diversification. This is like setting sail with multiple boats instead of putting all your hopes on a single ship. By investing in a variety of projects, you spread the risk. If one project hits an iceberg, your other investments can keep you afloat. It's a classic case of not putting all your eggs in one basket. Finally, we have flexibility. This is your ability to adjust the sails as the winds change. In other words, you maintain the option to adjust your project scope or delay decisions based on new information. Flexibility allows you to respond to change rather than being swept away by it. Remember, risk management isn't about avoiding risk entirely. That would be like trying to sail without ever leaving the harbor. It's about being prepared and making adjustments as needed to keep your investment journey on course. So there you have it. Contingency plans, diversification, and flexibility. 3 risk management strategies that can help you navigate the unpredictable waters of capital budgeting. With these strategies in your arsenal, you're better equipped to handle whatever storms may come your way. Think of these strategies as your safety net, catching you when unexpected events try to throw you off balance. Because in the world of capital budgeting, it's not about avoiding the storm, it's about learning to sail in the rain. Now let's bring it all together. Imagine you're at a crossroads with numerous paths stretched out before you. Each path represents a different capital budgeting decision. Some paths are smooth and straight, easy to traverse, while others are winding and bumpy, filled with potential obstacles. This is where risk analysis comes in, acting as your trusty compass, guiding you through this maze of decisions. Risk analysis allows you to weigh the potential rewards against the identified risks. It's like being at an all-you-can-eat buffet. You want to try everything, but you only have one plate. You need to prioritize. Do you go for the roast beef that could potentially be a bit tough, or the sushi that might just be the best you've ever tasted? Risk analysis helps you make that call. In the world of capital budgeting, the roast beef could be a project with lower returns but less risk, while the sushi represents a project with higher potential returns but also higher risk. You can't invest in all projects, you have to make a choice, and that choice should be informed, not just a roll of the dice. Risk analysis goes beyond simply looking at the potential profitability of a project. It considers the bigger picture, taking into account various factors such as market conditions, technological trends, and operational risks. It's like being a detective, piecing together different clues to solve the puzzle of which investment will give you the best return. You see, risk analysis isn't just about avoiding risk. It's about understanding it, managing it, and making it work for you. It helps you play the game of capital budgeting, not just to survive but to win. It's like having a secret weapon in your arsenal, ready to be deployed when you need it the most. And remember, risk analysis doesn't eliminate uncertainty. Life, as we know it, is inherently uncertain. The market can change in a blink, technology can evolve at the speed of light, and unexpected events can turn your plans upside down. But with risk analysis, you can navigate through this uncertainty, making better decisions despite it. Risk analysis doesn't eliminate uncertainty, it helps make better decisions despite it. So, there you have it. We've journeyed through the unpredictable seas of capital budgeting and risk analysis. We've tackled the uncertainties, the cash flows that are more like educated guesses than solid guarantees. We've looked beyond the numbers to consider operational, market, and technological risks. We've explored the toolkit of risk analysis, from scenario and sensitivity analysis to the high-tech Monte Carlo simulation. We've even plotted some strategies for smoother sailing, like contingency plans, diversification, and maintaining flexibility. But don't just take my for it. I encourage you to take these techniques and apply them in your own capital budgeting processes. Dive deeper, research further resources, or consult a financial professional for those more complex projects. Remember, risk analysis isn't about eliminating uncertainty, it's about making better decisions despite it. Remember, managing is key to successful and sustainable business growth. I hope you found this journey insightful. Now go out there and make some informed decisions. Before you go, if you found this video helpful, please give it a thumbs up. And if you want to journey with us through more financial seas, be sure to hit that subscribe button. Your support helps us continue to create educational content like this. Let's navigate the financial seas together. Until next time.